October 10th, 2025, a day that will be remembered as the largest liquidation event in the history of digital assets. Within 6 hours, over $19 billion in leveraged positions were liquidated across global crypto exchanges. More than 1.6 million accounts erased in a single trading session. Bitcoin fell 14%, dropping from $122,000 to just above $104,000. Ethereum dropped over 20%, and altcoins collapsed between 30 and 70. This wasn't a flash crash. It was a systemic unwinding of risk, the blockchain equivalent of a financial cardiac arrest. The breakdown started with excessive leverage. By early October, open interest in Bitcoin derivatives had reached record levels. More than $30 billion across Binance, Bybit, and OKX alone. Funding rates were near all-time highs, meaning traders were borrowing heavily to stay long, betting that Bitcoin would break through $150,000. But when macroeconomic tension hit, everything flipped. A new wave of U.S. tariffs on Chinese imports triggered a global risk-off sentiment. Equities fell, the dollar surged, and leveraged crypto traders were caught on the wrong side of the trade. As the liquidation engines activated, cascading sell orders spread through every major exchange. Order books thinned, market makers pulled liquidity, and the price spiral accelerated beyond control. Within minutes, algorithms overwhelmed human reaction time. The event didn't happen in isolation. Central banks were already under pressure. Inflation remained elevated. Interest rates in the US and Europe stayed above 5%, choking liquidity across global markets. Meanwhile, institutional exposure to crypto had never been higher. Funds, brokers, and even pension-linked vehicles held Bitcoin and Ethereum futures. When those futures collapsed, margin calls spread to traditional finance. Crypto didn't just fall, it transmitted volatility back into the real economy. For the first time, digital assets proved they were no longer a separate system, but part of the same fragile network that underpins global finance. On-chain data showed what no one wanted to see: massive transfers from whale wallets to exchanges. The prelude to liquidation. Billions in Bitcoin and Ethereum moved in minutes. Stablecoins like USDT briefly lost their peg, trading at 97 cents as traders fled to cash. The blockchain itself remained functional, but the infrastructure around it, exchanges, liquidity pools, and lending platforms, began to fail under the weight of forced liquidations. Protocols like Aave and MakerDAO triggered emergency shutdowns to prevent total collateral collapse. On Solana and Ethereum, gas fees spiked thousands of percent as automated bots fought for block space to execute margin calls. It was the first true stress test of the modern crypto financial system, and it almost broke. By the end of the day, Bitcoin stabilized near $104,000, a level that, months earlier, would have been considered impossible support. But the damage was structural. Liquidity providers withdrew, leverage dried up, volatility hit record highs. For retail traders, it was catastrophic. For institutional investors, a warning. And for regulators, confirmation that crypto had become systemically relevant. The market had grown too large, too fast, and too interconnected to fail quietly. The great liquidation of October 10th, 2025 wasn't caused by a hack, a bug, or a flaw in blockchain technology. It was human, driven by greed, leverage, and the illusion of infinite liquidity. The blockchain never stopped. Blocks kept forming, transactions continued, but the myth of invincibility died that day. October 10th, 2025, the day the decentralized market learned it was part of the system it was built to escape. This was the great crypto crash, and it changed everything.